Why most investors stay stuck, one step behind the market. Hello, I'm Vadim Poklopkin. Welcome to the chart of the day. 10 years ago, after the stock market crash, ratings agencies got a large share of the blame. Credit rating agencies and the subprime crisis was such a hot topic that it now has its own Wikipedia page. Many mistakes have been corrected since then, but one flaw remains. On that, consider this excerpt from our April 16th European short-term update. Spain's credit rating got an upgrade on Friday. What does that tell us? At ratings agencies, teams of people investigate the intricate details of companies' balance sheets as well as sovereign borrowers' income and liabilities. The ratings they assign are designed to aid investors. On the face of it, that sounds beneficial. Unfortunately, ratings agencies are almost always at least one step behind. This chart shows the Spanish 10-year yield spread over Germany, inverted. Spanish bonds underperform when the line is going down and outperform on the way up. We highlight the historical points when Spain's local currency debt rating got changed. In July 2010, even though the yield spread to Germany had widened from parity in 2006 to 153 basis points, meaning investors were demanding a much higher yield on Spanish bonds due to their higher perceived risk, Spain's debt still got the highest rating of AAA. In September 2010, Spain got downgraded to AA1 in a series of downgrades, culminating in a Baa3 rating in June 2012. By that stage, Spanish bonds were yielding 5% above German bonds. 1 month after that downgrade, the inverted yield spread reached its nadir and started to narrow. In February 2014, after Spanish bonds had outperformed and the yield spread had narrowed back to 200 basis points, Spain got upgraded one notch to Baa2. Now, in April 2018, with the yield spread at 60 basis points, a major agency is so comfortable with Spain's credit rating that they moved it up again to Baa1. The point is, agencies move the ratings only after the market price, which is discovered each and every day, has already moved. Because most market participants are conditioned to think that news headlines matter, they miss the point entirely that price moves first, and then the headlines follow. News doesn't make the price makes the news. This may be an esoteric example, yet the larger truth applies across all markets. Price moves first, and the headlines follow. Investors who make decisions based on the headlines, which is to say the majority, are inevitably caught one step behind the market. News doesn't make the price makes the news. In our experience, one way to get ahead of the price is to track the market's collective psychology, which unfolds directly in front of you on every price chart in the form of Elliott wave patterns.